Good afternoon, everybody, and welcome to our latest tax update from Brown Butler. Now, the topic for this one is basically the budget. We've clearly got the budget coming up on the 30th of October, and so what we're going to do over the next 45 minutes or so is go through what some thoughts in terms of what we think may be in the budget. That on our part, pure speculation. We have no inside track or anything like that. It's really based upon what we've been hearing, what we've been reading, and some comments around that and things you might want to consider doing in advance of the budget. Now, as always, we'll have three presenters: myself, Vicky, and Robert. And please feel free to ask questions as we go along, or alternatively, happy to pick them up at the end. The webinar is being recorded, so if you don't manage to see it all or you want to watch any of it again, you'll be getting a link for that sent across to you in the coming days, and it'll also be on our website and social media channels. So, without further ado, let's crack on. Now, the first topic I wanted to have a chat about was around low notes, where there's been a company sale. Now, this is important to the extent there is going to be any change to the CGT rate or to business asset disposal relief. Now, Vic and Robert will expand on these later, but this is just one particular aspect that I wanted to bring up now. Now, if somebody does sell, say, shares in a company and takes low notes, typically in the form of non-qualifying corporate bonds, the default treatment is that those low notes are subject to capital gains tax as and when they're redeemed. But the point here is that they will be subject to CGT at the rate prevailing at the time. Now, I think it's probably fair to say there will be some movement in CGT rates in the budget, and I think it's even more certain to say that that movement won't be downwards, it will be upwards. So with low notes, what you can do is that you can make an election for non-QCBs. It's under section 169Q of the Capital Gains Tax Act. You can elect to tax those low notes at the time of the initial transaction and then claim business asset disposal relief on the element that falls within your lifetime limit. So the low notes in effect are taxed upfront along with, say, the cash consideration. Now, in order to make this election, that has to be done usually within 12 months of the 31st of January following the tax year of sale. So if there's a sale in the 23-24 tax year, the election needs to be made by the 31st of January 2026. So looking at that, coldly, you'd say, okay, no need to panic. We can just wait, see what happens in the budget, and make the election after the budget if the rates increase. However, the last time there was a significant change in business asset disposal relief, and this was back in 2020, when the lifetime limit was reduced from £10 million to £1 million, and indeed it changed from entrepreneurs relief to business asset disposal relief. The elections to tax low notes up front were only valid if they were made before budget day. So the election itself had to be submitted to HMRC prior to budget day. Now, ordinarily, when you make this election, you do it on the self-assessment return, ticking a box on that, and it's all part and parcel of the return. So one thing you might want to consider is if you feel as though an election should be made to tax low notes up front, then you do it separately in writing to HMRC pre-budget day, if it's going to be a while before the tax return is going to be completed. Now, just a note of caution around this. Remember, there are other implications of making this election. And the main one is you lose bad debt relief, which is essentially what you get with non-qualifying corporate bonds under the default treatment. Because if you don't receive the consideration associated with those loan notes in the future, you don't get taxed on it under the default treatment. But if you make the election to tax the loan notes up front, and you subsequently don't receive all of the loan note consideration, what you end up with is a capital loss in that period in which the loan note isn't redeemed in full. Now, with that capital loss, you can't carry it back and set it off against the initial gain. You have to set it off against other gains arising in that period or gains arising in the future, which, of course, not every taxpayer may have such gains arising. So there is a risk in making the election in terms of losing that ability to claim bad debt relief on the loan notes. That's certainly something that should be given some consideration when you're looking at the disposals that happened in 23-24. Now, changing tack slightly, and this isn't necessarily budget related, but it's something that's certainly topical, as anybody who's dealing with R&D is probably aware. HMRC have increased their compliance activity considerably over the last 12, 18 months or so. In particular, software R&D is an area they are concentrating on, and certainly being quite aggressive in the way they're dealing with software claims. But there are also some compliance obligations which it's really important that everyone is aware of in order to make that R&D claim in the first place. Now, the first compliance element is around notification of claims, and this is becoming relevant now, as you'll see, in that for accounting periods beginning on or after the 1st of April 2023, you have to notify HMRC within 6 months of that period end that a claim is being made. So, for example, if you've got an April 24 year end, the notification needs to be made by the 31st of October 2024. Now, there is no need to make a notification if, very broadly, you've submitted an R&D claim in the 3 years prior to the notification deadline. So if R&D claims have been submitted within 3 years of the current period, then usually you wouldn't need to make that notification. And also, you don't need to make the notification if the claim is actually made before the notification deadline. But given that's 6 months after the year end, you'd have to be pretty organized to get the CT return and an R&D claim submitted within that period. Now, the notification is made online by an HMRC portal, and in essence, you just set out some very basic information. There's no detail required in terms of quantification or a detailed narrative around the claim. It's just giving a broad overview of what the claim entails. And just because you make a notification, it doesn't mean that you have to go through and make an R&D claim. You're simply making HMRC aware that you may be making an R&D claim for the period. Now, the other compliance aspect, which is equally as important, is the requirement to file an additional information form prior to submission of the corporation tax return. And this applies to any R&D claims which are going in now. This came in August last year. So before any R&D claims for any company being submitted, this additional information form needs to be completed and submitted to HMRC. Again, it's for a separate portal. Now, with both of these compliance obligations, if they aren't met, then the R&D claim will simply be removed from the corporation tax computation. Now, of course, with the notification angle to this, if the notification isn't met, then there's no remedy for that, because you've missed the boat to actually make a claim for the period. If the additional information form hasn't been submitted, then you could submit an amended return if you're still in time after you've submitted the additional information form to HMRC. But two very important compliance aspects that it's worth remembering as far as R&D is concerned. Now, I keep the focus on R&D because, like I say, it is in the headlines, and indeed, in the last week or so, two R&D advisory firms were raided under fraud allegations. These were Green Jellyfish and Kirby and Haslam. Now, this has all come out of HMRC's increased compliance activity, as I mentioned before. And in HMRC's words, these arrests are just one small part of a comprehensive and wide-ranging action we're taking to tackle suspected R&D fraud. So, the revenue are taking this seriously. Several premises were raided as part of this investigation. And I wanted just to touch on a couple of R&D cases. We're seeing some cases going through the tribunals now, and I've just summarised two here with different results, but nevertheless two cases that are worth just going over because there are some learning points surrounding these. Now, the first one is Get On Board Limited, and this was actually a software company. So whilst I said earlier that the revenue are taking quite an aggressive stance with R&D claims for software development, in this case, the taxpayer actually won. And it did revolve around whether the activities of the company constituted R&D. Now, in this case, there was some compelling evidence from the competent professional, as it's called in the regulations, which is different to a case from a few months ago now called Flame Tree Publishing, where there was no credible witness for the taxpayer. Now, Get On Board, they developed some AI software in the field very broadly of anti-money laundering checks. And the revenues view that there was no overall advancement in knowledge in that area. The revenue basically stated that AI, algorithms, data manipulation, it may have been novel and difficult to achieve. However, there's no evidence of any advance in technology in the process. They believe that the product used existing processes and technologies that were readily deducible to a competent professional. However, like I say, the director that gave evidence at the tribunal was very credible, and furthermore, in this case, the HMRC inspector's evidence was a little bit undermined because they admitted they had no technical or technological experience or expertise, and the tribunal did find that that the technology did seek to achieve an advancement in that in that particular area. Now, there is one point to note here that this was a first-tier tribunal case, so it does not set a precedent, and at the moment we don't know if HMRC may appeal against it. But what was interesting around this was that the arguments that HMRC were making about you just using existing technology that's there, and this is a frustration I get sometimes with R&D claims. If that was the case, using the revenues argument, then no software development could ever be R&D because they are all using existing algorithms, etc. So, there is there are some good arguments in the case notes around that particular area. The other recent case is Tills Plus Limited. This one didn't go as well for the taxpayer. Again, software development, but in this case, the company lost the case. The activities, it was found, didn't constitute R&D, and here there were some inconsistencies with the information that was supplied to HMRC at the start of the inquiry, and as the inquiry progressed, there were contradictions in subsequent submissions. The submissions tended to be more of a commercial nature and a non-technical nature, rather than looking at the technology behind what was being developed. So the point here is that I think in any inquiry around R&D, and indeed in pulling together the claim in the first place, it is important to use the competent professionals within the company who have that technical background, who can explain why something is innovative, why it's moving the boundaries of science and technology in a particular field. And finally, from me, I just want to give you a bit of a roundup of latest news in the tax world, and also some reminders of deadlines coming up. So first of all, EIS and VCT tax reliefs have been extended to April 2035. Now, these reliefs did contain a what's called a sunset clause, which would have meant they ended in April 25, but now that's been extended for another 10 years. A reminder that PAY settlement agreements 23-24, the payment of tax and I is due on 22nd of October if it's an electronic payment, or 19th if it's by post. And of course, with this, these calculations need to be submitted to HMRC first. And the easiest way of doing that is online through the specific portal set up for these purposes. And just a note on HMRC's move to digitization. They are going to stop sending some paper, what they call non-statutory corporation tax correspondence, where customers can access that online through their online gateway. So things like the return reminders, installment payment reminders, interest rate statements, and payment receipts will no longer be sent by hard copy. And from October, HMRC are also going to stop sending the CT 603A. Now, this is the agent list of issued notices to deliver a corporation tax return. So this is a letter we get as agents saying these companies are due to file a tax return in the next month or whatever. But that's no longer going to be sent out in hard copy form. Right, I'll now pass you over to Vicky, who's going to pick up on private client tax and talk a little bit more about the budget and potential changes. Thank you, Vicky.
Thanks, Craig, and good afternoon, everyone. As Craig said, I'm going to talk you through some private client matters and initially focusing on some possible predictions for the budget. There's obviously a lot of discussion going on at the moment about what may or may not be included. And if only we had a crystal ball, we'd be very, very wealthy people. So obviously, we don't know what's going to be in the budget, but these are just a summary of some of the thought pieces on it to help consider what steps people might like to take. So Rachel Reeves has said that there's many more difficult decisions to come. And obviously on the 30th of October, we'll know more about how she's planning to move things forwards. Areas that we're thinking there could be changes to are inheritance tax, capital gains tax and pensions. And those are areas because there are some taxes that Labour promised not to raise, particularly when it comes to employees. So those were income tax, national insurance and VAT. It's hard to estimate the impact of some potential changes that are being mooted. because some of the changes could actually cause people to change their behaviour and therefore not do certain things. So in the coming slides, I try and focus on the taxes, the inheritance tax, the capital gains tax and the pensions, and look at what might happen and how likely it is. So first of all, looking at inheritance tax possibilities, the rules as we've had them have been around for a number of years, and some of the thresholds and tax rates haven't altered for a number of years either. The current rate of inheritance tax is 40%. And so it is possible that they would choose to increase that rate of inheritance tax maybe to 45% or 50%. Now, at the moment, less than 1 in 20 estates actually pay inheritance tax. So whilst the receipts from inheritance tax are going up because, you know, the value of assets are going up and the thresholds haven't altered, it isn't actually that significant a revenue raiser overall. And if there are changes to inheritance tax, then it is likely to be an area where the more wealthy individuals that are being hit more would be able to seek expert assistance and try and plan around the impact of those changes. Now, if the rates aren't changed, or if they are changed, they could also look at altering the inheritance tax nil rate bands. Now, currently the nil rate band is £325,000 per individual, and that hasn't increased for a number of years. And so if they were to alter the threshold and reduce the threshold of the inheritance tax nil rate band, that would obviously affect many more people. And there would be other allowances that would be less controversial to alter than the actual nil rate band itself. There are other nil rate bands available to do with the residence nil rate band. That's not a particularly popular additional band because not everybody qualifies from it. There are various different technicalities attached to it. So again, it's possible that there could be changes to that to either simplify it or I guess potentially to get rid of it altogether. Now, currently, there are favourable tax rules for transferring assets between spouses. That's individuals that are either married or in a civil partnership. Now, there would be huge negative impact if they were to change this particular tax treatment. And looking at the other options they have, there would be many more less controversial ones. They've obviously had a lot of bad press recently for taking away the winter fuel allowance from the older taxpayers. And if they were to alter the ability for married couples to pass assets efficiently between themselves without triggering tax charges, there would be a significant increase in anxiety about inheritance tax. And there would be a considerable amount of negative press because it could lead to a situation where a spouse is having to pay tax on assets that are left to them, and that surviving spouse could be forced out of their home. So whilst it is possible that some of the rules could be altered, potentially to limit how much can be transferred in a tax-free way between spouses or civil partners, you know, this would be an area that would be a negative, particularly negative for them if they chose to do this. So then moving on to some other possibilities, there are favourable tax reliefs included within the inheritance tax legislation that allows particular assets to pass down without having to worry about inheritance tax. Now, principally here, we're looking at business property relief and agricultural property relief. And within these reliefs, there are various different conditions, both in terms of what assets qualify and how long you have to have held the assets for. Now, it is thought that change is more likely here or potentially within this arena. So it's possible that they could apply these tax reliefs to fewer assets and in more limited circumstances. But what they do need to try and be careful of is not having a particularly negative impact on the economy, because obviously they need these businesses and farms to be able to survive, and they're employing individuals, for example. So there does need to be thought given to making irreversible harm to, for example, family farms or indeed, family-run businesses. And so, like I say here, they could look at limiting the conditions for what qualifies for agricultural property relief and the assets that business property relief applies to. Sort of, as well as that, they could look at making it harder to qualify for these reliefs, so they have to be held for a longer period of time. So, for example, for business property relief for shares that qualify, there's a minimum holding period of 2 years at the moment, and a possibility would be that they could extend that to perhaps 5 years, or they could cap the maximum relief available within a lifetime. There are no caps for relief within inheritance tax at the moment, but there have been caps around for a while within the capital gains tax arena, thinking here of entrepreneurs relief that's become business asset disposable relief. So again, it's a possibility that they could introduce a lifetime allowance, or they could reduce the amount of relief that's available from, for example, 100% to 50%. Now, as I've said, the various assets that do qualify for these favourable reliefs, the reliefs were there for a reason, to help these industries and sectors survive more and not have to worry from the disadvantages of taxes being paid when they were passed on to the next generation, for example. So they would think that they'd need to be careful of impacting investors, for example, that invest in AIM listed companies that qualify for these tax reliefs, because it could jeopardise the investment in them, which is vital for them to get off the ground. So as well, some other changes in here. At the moment, if there's inheritance tax, well, when inheritance tax applies on death, you don't have to worry about capital gains tax predominantly. So essentially, beneficiaries that receive assets on death receive those assets with a base cost of capital gains tax at the probate value. Now, there can be particularly favourable if you've got full business property relief or agricultural property relief on these assets that are inherited. You haven't suffered any inheritance tax, and if you sell them more or less straight away after the death of the individual that you've inherited from, there wouldn't be capital gains tax either. So this is something that's come out of recent documents from the Office of Tax Simplification over, say, the last 5 years. This has been something that's been noted. So this could seem like an attractive option for the government to increase the taxes in an area that they see as being overly generous to some sectors. Now, there has been also a lot of discussions about pensions and whether they could be brought back into being subject to inheritance tax. So thinking here of pensions that have a value that can be passed on after you've died. And these do have a favourable tax treatment compared with other assets that are treated as investment assets, because investment assets you don't tend to get favourable treatment for within the inheritance tax regime. As well, if they made some changes to the arena of pensions, it could be thought that it would impact those with the larger size of estates who are choosing and have the option not to spend their pensions and are spending down other assets instead. But it would also have a negative impact on those who die early and haven't had a chance to access their pension pots, or who are planning to use their pension to help them reduce their inheritance tax bill. And I'm going to come on to some other non-inheritance tax comments on pensions a bit later. Now, as well, there could be changes to do with the gifting rules that are contained within inheritance tax. At the moment, you tend to have to look back 7 years from death to see what gifts have been made and whether there's any additional inheritance tax on those gifts that haven't been survived by 7 years. It can go up to a 14-year period where you've got trusts involved. So that could be an area where they restrict the amount of gifts that you can make, or whether they extend the amount of years that you have to consider that you've been making gifts for before you die. And there is also very favourable relief known as the regular gifts out of income relief that can apply to individuals that have significant income that they're not spending after tax and their routine expenditure each year. They're actually can be able to give that away without having to survive 7 years, so long as it's a regular intention for that to continue. So again, it could be seen that that's a particularly generous inheritance tax relief, and should they make some changes to that to curb it and get more taxes on those gifts. So in terms of what steps can be taken before budget day on the 30th of October, I've got a summary of some things that could be thought of here. But one of the things that I just want to say is that it isn't usually advisable to act on budget speculation alone, when contemplating significant changes to what you were doing. But if you were planning to do something anyway in the shorter term, then it would seem sensible to think of bringing that forward to before budget day, and then you should be benefiting from the relief for the tax rules as we know them now. And I'd also say that the management of wealth and assets is not just dictated by what the tax treatment is. It's only just one factor that should be considered. So decisions that are being made need to take into account, broader issues, the broader family dynamic, asset protection, and not just looked at from a pure tax position. So in terms of things that can be done, everybody has an IHT annual exemption of £3,000 per tax year. So if that hasn't been used, it would make sense to think of using that before budget day in case that's removed or reduced. If you're thinking of making gifts, as I say, in the near future, then you might like to bring those forward a little bit to before the budget. If you've been making regular gifts out of income, again, keep up that intention and potentially if you were wondering about doing them, this month or next month, potentially do them this month. But do make sure that with any of these things that you're happy that you can afford to part with whatever you're thinking of gifting. And you should always make sure that you retain more than enough with a cautious view to what you need in the future. And don't let anxiety rush you into doing anything. You should feel comfortable and have fully looked through the implications before you do anything. Just a reminder here that if you're gifting cash, then there shouldn't be any capital gains tax implications. But if you're making lifetime gifts, it isn't only the inheritance tax position that needs to be considered. You do also have to think about the capital gains tax implications as well, because under the current rules, if you're making a lifetime gift and it's an asset that's subject to capital gains tax, there will be capital gains tax implications as well that need to be considered. And you could potentially be triggering an additional tax that doesn't exist currently on death. And you could also think about whether you invest in assets that qualify for tax favoured status, such as ISAs, where the interest and dividend income isn't subject to tax at the moment under current rules. So just a reminder there of some of the things that could be done if you were wanting to before the budget day. Now moving on to capital gains tax. This is an area where there are more likely to be changes, and as Craig said, it is felt that the capital gains tax rate could well increase for at least certain assets within the capital gains tax regime. Business asset disposal relief is a favourable tax relief that can apply to individuals that have trading assets and qualify for this relief. And the benefits of business asset disposal relief, previously known as entrepreneurs relief, were significantly curbed in 2020. So currently, if you qualify for business asset disposal relief, you can access a 10% capital gains tax rate on certain business assets up to a £1 million maximum of capital gains during your lifetime. That means there's a potential £100,000 capital gains tax saving during your life, but before 2020, that was much more generous as the gains threshold was higher at £10 million. Based on HMRC's estimates, this business asset disposal relief costs about £1.5 billion annually. So it would go a little way to filling some of this £22 billion black hole that's being mentioned. It could be scrapped or the cap could be further reduced to below that £1 million threshold. Now, if it was scrapped, it would have a disproportionate impact of owners of smaller businesses and management teams who are being incentivised with shares or share options. So there would be a sector of society that would be disappointed by that. But overall, I guess looking at the whole population of who pays capital gains tax, if there was the choice between a substantial increase in the rate of capital gains tax so that it got increased above the current rates, or getting rid of business asset disposal relief, I think many entrepreneurs would prefer that this relief went rather than an increase in the tax rate. So in terms of other things with capital gains tax, again, they could choose to change one, or they could change to alter a number of these different aspects, or do none of them and come at us from a different direction. But there has been a lot of discussion about increasing the tax rate to match income tax rates, because the highest rate of income tax is 45% at the moment, whereas the highest rate of capital gains tax is 24%. They could change the rules on when capital gains tax becomes payable. So that would be looking at some of the scenarios I mentioned to do with, transfers between spouses being tax neutral at the moment. So there's no tax payable when it goes between spouses. Or they could change the rules on what assets are actually subject to capital gains tax. Now, there is a capital gains tax annual exemption still at the moment. It has reduced significantly from several years ago, where it was over £12,000, and currently the capital gains tax annual exemption is only £3,000. So is the direction of travel with that they're planning to completely abolish having any annual exemption, because it's difficult really to see how much further they could reduce it. With it having any benefit to anyone, or there could be a combination of these different factors. Now, in terms of pensions, then looking at it from the relief that people get on pensions, they could choose to reduce the tax relief that people get on pension contributions. So at the moment, if you're within the thresholds for making personal qualifying contributions to your pension, you can contribute up to £60,000 if you have enough qualifying income that matches that, and get the highest rates of tax relief on your marginal tax rates. Now, it could be that there's a single flat rate of relief, so potentially it could be just for the higher rate taxpayers and additional rate taxpayers capped at 25% or 30%, or they might do one flat rate so that everybody gets that. So it incentivises those that pay the basic rate of tax, where they'd get a bit extra relief, and it would be there'd be less tax relief for the higher taxpayers. Now, the estimated net cost of pensions tax relief for the 22-23 tax year was just shy of £50 billion. So that's almost 3 times as much as the capital gains tax receipts that were received in that tax year. And there is a perceived unfairness that half of the tax relief goes to higher and additional rate taxpayers, who arguably are in a position that they can suffer more taxes. Now, if the flat rate was taken at 30%, I think there has been an assessment that the impact might actually be only an additional 1.5 billion of income tax would be got in by HMRC, and it would be quite complicated to achieve. But as I say, it is possible that pensions would be something that would be changed. Also linked to pensions, there's currently a tax-free lump sum that can be taken, which is 25% of the pension pot. It is possible that there will be some changes made to that. I've read today again that it's possible some people are saying that it might be capped at a certain level, like £100,000. So that is an area that could be looked at. Again, if you're thinking of accessing a tax-free lump sum in your pension because you're worried you might not be able to take as much out after budget day, you would want to take proper financial advice on that to understand what implication that would have, and also whether it would restrict you if you were still wanting to make additional pension contributions after that, because it is a complicated position and you do want to understand all of the facts surrounding it. There have been some discussions about whether pension contributions could be brought into having national insurance on them. So there is a whole host of things that could potentially be changed here. And the point here is it's balancing incentives for those who are at risk of undersaving for retirement against the huge scale of pension wealth, which make mistargeted rules costly. So again, pensions is something that we think could well have some changes, and they could reintroduce potentially that lifetime allowance as well. Now, there have been some measures already announced, and these have been confirmed to be included in the finance bill. Furnished holiday lettings tax regime is being abolished from the 6th of April 2025, and we have spoken about that in previous sessions of these. Now, over the last month or so, it has been announced that the VAT on private school fees is definitely coming in, and that's going to apply from the 1st of January 2025. And will be at a rate of 20%. Any school fees that have been paid since this announcement was made on the 29th of July, and which relate to the term starting in January 2025 will be subject to VAT. And the changes to the taxation of non-UK domiciled individuals is coming in from the 6th of April. And they have said that it's going to go further than was announced in the spring budget. Although over the recent week, there have been some thoughts that they're getting worried about what the effect it is going to have on people leaving the country and whether they might actually revisit some of their manifesto promises on that. So again, there are changes coming to non-UK domiciled individuals. There have been a number of statements about what they're planning to do, but in the budget, hopefully there will be a clearer idea as to whether they're going to go as far as they said in their manifesto or not. So we have talked a lot there about possibilities that could come in with the budget. So hopefully that's helpful and gives you a bit of an idea as to what could happen and how you can bring that into your thought processes at the moment. But just a reminder that with tax returns, if you have a requirement to complete a tax return and you're not already within the self-assessment net, the 5th of October is a key date to register yourself for the need to complete a tax return. Because thresholds have remained frozen for a number of years, there are more people that are falling within the tax net and therefore more people that would need to register for tax returns. And one area here is interest, because interest rates have been favourable, particularly over the last 12 to 18 months. And it's predicted that a record 2.1 million people will have to pay tax on their savings interest this tax year. And 1 in 30 basic rate taxpayers are expected to pay tax on their savings this year, and that compares to just 1 in 100 3 years ago. So banks do share interest earned directly with HMRC, and sometimes that information cannot be completely accurate. For example, if you had a joint account and your spouse has died within the year, it might be wrong as to who would be taxable on that interest. But it is likely that if you've got significant amounts held in cash, that you will have received a significant amount of interest and could be over the threshold for needing to submit a tax return. For example, if you've got interest over £10,000 in the tax year, that is one of the requirements for submitting a tax returns. If you're under PAYE, it is possible that you've got your interest coded into your tax code rather than self-assessment. But just do bear this in mind, and if you're in any doubt, there are some questionnaires on the Revenue website that allow you to see if you should be submitting a tax return and needing to register for that. Now, just some other high-level comments just to finish my session with. HMRC's Trust Register has been around for a number of years, and there is a penalty regime included within that for late submissions or not keeping the items updated. We are beginning to see HMRC sending letters out asking if the details are up to date, and if not, saying that they could well issue a penalty if things aren't remedied. So that is an area that if you're in any way connected with trust, or there could be a trust viewed over assets, to make sure that you're in line with those rules. And we have done some sessions over that previously. And then just finally, just a note to the Revenue are sending nudge letters to more and more people. And there is guidance out there as to what the recommended course of action is to do these. But typically these are identifying particular individuals or taxpayers who might not be meeting their obligations and who it would be sensible to revisit and check that they are doing the right thing. So here we've got dog and cat breeders, we've got tax returns for previous years where individuals are earning more than £200,000 per annum, looking at crypto and digital assets, looking at individuals that have been receiving child benefit but shouldn't have been and have a high income child benefit charge, and people that have put in investors relief claims that had exceeded the limits or that weren't valid. So I know that's been a whistle-stop tour of a few different sections, but hopefully it's helpful. And I'll pass you on to Robert to talk about some thoughts and things that he's been seeing out there to do with pre-budget planning. Thank you.
Yeah, thank you for that, Vicky. Yeah, lots to digest, lots to think about there. I'm taking a slightly different approach in that the only prediction I'm going to make in relation to the budget is effectively if we do end up putting the rates of tax up, that is more than likely going to encourage a certain portion of the tax-paying population to explore, I guess you might call, tax mitigation strategies in which to alleviate the additional tax burden, really. So certainly three areas where I just wanted to touch upon with some sort of, again, planning ideas that have been presented to us. Just want to point out we don't agree with these ideas in the format that they have been presented. So I just was quite conscious that the likes of yourselves may well have had contact from a client or indeed another sort of firm to say, this is a really good opportunity for your clients. You'd be stupid not to do it. But as for Croatia has been talking about, HMRC are really clamping down, particularly in sort of legitimate reliefs like R&D. We've got there just made a reference to the Duke of Westminster case. That's the famous every man is entitled to arrange his affairs such that he reduces his tax burden. But I think fundamentally from our point of view, given the current climate we're at, if you are kind of coming across something which looks a little bit too good to be true, then it probably more than likely is. So yeah, the three taxes I just want to talk about. We know, of course, as Vicky just mentioned, there is going to be VAT now levied on school fees. So we've got parents there thinking, option A is to take children out of school. Option B is to make sure I earn enough money to cover the additional charge. And of course, that's the increase in their gross pay, because obviously they're going to have to account for income tax on that. A very, very quick look at CGT, and there's also another sort of strategy we've seen a couple of times now in relation to IHT. So we just flip on to the next slide, Craig. Yeah, so we're just going to talk through this diagram. Now, this is not a way to remove, if you like, the VAT charge on school fees, but it is this way of potentially, parents are able to extract more income from their limited company and pay tax at a lower rate effectively. So the way that this would work and the way that this gets touted around quite a lot is mum and dad are joint shareholders, just for argument's sake, in their own limited company. They're drawing down a dividend and a salary each year. A portion of that salary is being paid over to their children's private school. Now, mum and dad could potentially just create a new class of share in their company, and they could just transfer that into, let's just say, a trust, and the trust could pay the school fees on their behalf out of dividends arising from the company. The issue with that will be that the children in this case will be expected to be under the age of 18. And effectively, then we've got a settlement for income tax purposes. So mum and dad have actually done nothing more there than to put in place a complicated structure which simply tax them on the receipt of dividends in the trust. It taxes them directly. So they will be paying the income tax on that in any event. So the way that's been proposed to get around that fact would be a new class of share is created in that case, Mum and Dad Co Limited. That new class of share has dividend rights, but has no capital rights, has no voting rights. So the argument would be on day one that's actually worth very, very little effectively. They then ask or encourage, should we say, normally a grandparent or another sort of close family member to subscribe for that new class of share at its nominal value, which, as I just said, would be expected to be relatively small. The family member actually then subscribing for that share settles the shares into the trust for the benefit of the parent's children, and thereafter the company declares a dividend on those shares, normally up to the children's personal rate allowance, so it's £12,500 each. And the idea is because mum and dad have not settled that trust structure, it's been grandparent or other family member, then that can sidestep the settlements legislation, and mum and dad would not be subject to income tax on any payments of dividends into that trust. Just go on to the next slide, please, Craig. Yeah, so that's actually just confirming pretty much exactly what I just said in a bit more sort of brief detail. So those are generally the types of fact patterns that we see. But the risk here is that HMRC are probably in the past 12 months, there's a chap on LinkedIn called Dan Needle that's so very keen to highlight sort of firms of a bit of a dubious nature, sort of advertising this type of planning. And that has actually gone so far as to the fact that HMRC have looked into this, and they've actually now got Spotlight 62. Spotlights there are really in relation to sort of strategies that HMRC are aware of. They've made a confirmation that in their view, these do not work. And they effectively kind of advertise that fact to encourage anybody that has used a similar type of structure to come forward and own up, for want of a better description, and to settle their tax affairs that way. The risk, of course, with them not doing that, and it just lets matters continue and see what happens, is that HMRC do come back in a few years' time and say, "Oh, by the way, you owe us back taxes for the past 4 to 6 years or longer in some cases." So eventually, all that planning, all the fees that mum and dad have put into this to set it up in the first place, effectively, it's all been for nothing, and they're left with a fairly sort of hefty tax bill, plus interest and possibly penalties as well. So it's very much just, if you've seen anything like this come across your desk and it sort of does closely fit that sort of steps 1 to 6 there, then it is very much a question of actually stop and think and ask somebody for a second opinion. Just come to the next slide there, Craig. Now, in essence, not categorically say that this does not work in the format that I just presented, then yes, it probably would not work from HMRC's perspective. But there could well be some variations around the same theme, which would put the taxpayers in a less risky position, put it that way. So just sort of listed sort of 3 ideas there. Just picking up on what Vicky said in relation to the trust register. I mean, in this structure, we are using a trust, and the trust will be registered with HMRC. And it is quite sort of easy to tell that this is the such and such grandparent settlement on behalf of little Johnny and little Timmy, for example. Then HMRC would have a natural course there to start asking questions and having a look at the various tax returns that do get submitted, which do purport to actually sort of back up this type of solution. But certainly speaking, I think the top one there, if we've already got grandparents with income-bearing assets, shares, properties, that side of things, then this is still sort of very much valid planning. The question there will be, how much influence, should we say, have their own children put on them to set this type of planning in place. But certainly speaking, there are, potentially sort of ways we can have a think about this in the round. But as I say, certainly speaking from our perspective, that structure, as I've just outlined, very, very risky. Get a second opinion on that, and obviously we'll be more than happy to talk that through with you. So the next slide, Craig. So this one necessarily isn't a CGT mitigation strategy per se, but I've just repeated out the relevant legislation there in relation to how this be purported to work. So we have an exchange of unconditional contracts, and by unconditional I mean there are no conditions in the contract. A condition in the contract might be that, say for example, in the sale of a property, the current owners of the property are going to knock down the inner walls, for example, before the contract's actually completed. So where we have an unconditional contract where there are no conditions in there, the actual tax point is at the time of exchange, albeit the fact that tax is payable on the completion of the contract itself. So in a situation where we have a potential of the CGT rates going up, one of the options that taxpayers are sort of being advised to do is almost kind of create now an unconditional contract. Just drop onto the next slide, actually, please, Greg. We're actually just sort of creating an unconditional contract with a connected party because they've got obviously complete control of that. That can be a company or it can be a trust. Before the budget, we had this unconditional contracts in place, and that contract can be rescinded at any one moment in time. So eventually when a potential third party comes along, which could be 6 months, 12 months later down the line, they would actually be contracting with the connected party to purchase the asset. And it would be at that point that the connected party contracts and exercises the contract with our own client and actually sort of formalises the completion of that. But importantly, if the argument here being that the actual unconditional exchange between the client and a connected party was pre-budget, then the rate of tax for CGT that should be applicable is the current rate, regardless of the fact that the latter contract, the actual contract with between the third party and the connected company or connected trust with the client, albeit the fact that has completed at a later date, the actual tax rate we're using is the one as of today's date. Go on to the next slide, please, Craig. So, as you might imagine, there's a few sort of things to think about here. I'm not going to go too far deeper into the legalities, but certainly speaking, this is very much a legal point, with this unconditional contract, which is potentially going to be rescinded if a latter contract does not complete at a later stage. What exactly has be agreed to be in exchange at that point in time? Is there actually any kind of contracts in place at all, or to just disregard the entire thing entirely? Reference to what Craig was saying as well, there was some anti-forestalling legislation when the change from entrepreneurs leave to business asset disposal leave actually occurred, and that effectively just sort of knocked out this type of planning in its entirety, really. It just basically said that the disposal for tax purposes in contracts deliberately designed to take advantage of the Section 28 TCJA rule would just completely disregard that in its entirety. But if you kind of imagine, that's not going to be an immediate question that HMRC would ask. This would be as a result of potentially a fairly long inquiry. If the tax has already been paid, which we would expect it would have been at that point in time, there may well be interest and penalties again accruing to the client. And of course, putting in place a step like this, if it's just going to kind of unwind itself and not be fruitful, then again, they've expensed a fair bit of money on professional fees and legal fees to get this set up for potentially no advantage whatsoever, really. So that's just something to be aware of. And this last point, really, coming back to Vicky was saying again around, are there going to be some curtailment, if you like, of business property relief in relation to inheritance tax? Now, let's just say, for example, we've got a client with a company which is purely investment, does no trade whatsoever. Classic case would be a property sort of rental company. So on normal principles, there would be absolutely no business property relief available, subject obviously to a few conditions. But what has been proposed by a few is where the shareholders transfer their shares in that company into a trust that qualifies under Section 86 of the Inheritance Tax Act, then provided the conditions for Section 86 are met, then the value of the shares in that trust are actually free from inheritance tax. If you just drop onto the next slide there, Craig. So that's just the actual sort of confirmation there of the relevant points. But what you would have seen there, just very, very briefly, is a Section 86 trust is set up for the benefit of the employees of the company. And that will more than likely get a few alarm bells ringing with a number of you. The first point I've made there is around the loan charge. So slightly different. I mean, one of the sort of instances were the EBT set up by the various people to extract money out of their companies. The argument is always they do actually qualify under Section 86, but as you may well have sort of come to the conclusion, HMRC really don't like Section 86 trusts, even when they are used for the most legitimate lawful purpose. And particularly thinking about a family company, the only employees of that company are more than likely going to be the shareholder directors themselves, and also probably close family, children being a classic case. So as you might imagine, use of Section 86 trusts in inheritance tax planning have been sort of fraught with danger. We do have a GAR opinion in relation to a Section 86 trust plan purely for inheritance tax purposes. I'll put the link up there just in case anybody wants to click through and have a read through that. Might sort of resonate with a few sort of facts you've seen. Also, DOTAS. At the moment, there isn't a DOTAS number in relation to specific Section 86 trust planning for IHT. But certainly speaking, it will meet the first condition of DOTAS, which is there is definitely a tax advantage which has been created here. The second condition is that the arrangements need to be abnormal or contrived. And in the case of the actual GAR decision you got there, the lady, just very, very briefly, appreciate we're getting close on time. The lady was unfortunately terminally ill, and she did have quite a large cash balance in her bank account. And the expectation was she was not going to survive 2 years. So sort of investment into AIM qualifying shares would not be an option for her there. So what she was advised to do was actually set up a new company and capitalize that company with the cash in her bank account. So convert that all into shares in the company. She was then advised to transfer those shares into a Section 86 trust. And she did actually survive about 9 months following the date of the completion of those steps. And of course, her executives are arguing that no, this is Section 86 trust. It qualifies for, effectively, there's no IHT on that. So what's he complaining about? And of course, that, as you might imagine, the only possible reason for her actually implementing that strategy was in contemplation of her death. And unfortunately, that's become an abnormal and contrived step for DOTAS purposes, really. So with that in mind, this is very much a strategy which we would avoid at all costs. I've just very, very quickly listed there a few other options which are available in this situation. But I guess just to kind of highlight, in the case where we have got investment companies and we are looking at inheritance tax planning, there isn't really a silver bullet. We just need to work through a number of options and a number of steps which will sort of alleviate the concerns of the client, working in tandem with their solicitor and also working in tandem with financial advisor as well. But certainly speaking, there is no kind of off-the-shelf one-stop solution in relation to that as far as we're concerned. And that just brings me on to the end of my section.
Thank you, Robert, and thank you, Vicky. And thank you all for listening. I hope you all got something out of that session. We'll find out in 4 weeks' time how good, bad, or indifferent any of those predictions were. Just a reminder that this webinar is being recorded, so feel free to dip into it again. And given that there is likely to be some substantial changes in the budget, I think we'll all be staggered if there aren't some significant tax changes coming up. We'll probably run a kind of budget special webinar, maybe mid-November time. Wait for the dust to settle on the budget. Give us all a chance to digest what's in there. As always with these things, the devil is often in the detail, not necessarily in the headlines. So we may well have another webinar mid-November. If we don't, we'll certainly have one at the start of December. So thanks again for listening, and we have no questions coming in. So remains for me to say goodbye and see you soon. Thank you.